What's going on, everybody? It's Jeff here. Welcome back to the channel. Big news, kicking the year off right. Another hedge fund is closing its doors. Credit Suisse, which is a massive firm with multiple different divisions. We're going to take a look at what happened and why this is starting to set up to be a little bit bigger, because we've talked about these small funds starting to fold up. I've even posted articles, not only on Twitter, but we've shown on videos before, how there are multiple different hedge funds that close their doors every single year. And exponentially since 2016, the number of hedge funds that have gone under has risen. Credit Suisse, which is not solely a hedge fund, is still a very, very big firm. So we're going to take a look at what happened and what I expect to see for the rest of the year, especially because interest rates are starting to rise. I'm going to make another video later on talking about what the Fed just said, but also the fact that we are inside a very choppy market. It's very difficult to see exactly where the trend is going. Now, if you zoom out and look on a weekly or monthly time frame, yes, you can still see we are in an uptrend. When you narrow it down a little bit closer, and especially everything that is going to happen this year as far as federal regulations, it's hard to determine exactly which direction we're going. So like I said, this is only the beginning, but let's take a look at exactly what happened. Here's an article just stating Credit Suisse to lay off New York employees as it shuts hedge fund division. Now, Credit Suisse had served multiple different hedge funds. And as you can see right here, it was hurt by the Archegos capital management collapse. All right, it's actually going to signify about a $5 billion loss for them. The new management that came in vowed to stop lending to hedge funds and processing their trades. They really just couldn't compete with the other big guys such as Morgan Stanley, Goldman Sachs, and JP Morgan. But another thing I want to look at a little bit closer is that this has been going on for quite some time. As you can see, I think I have it down here, the bank had about 7,500 New York employees in 2017, according to figures from eFinancial Careers, which is about 1/7 of their workforce. So this has slowly been unwinding. They've been struggling. They've been battling losses. All right. And as they continue to try to bet against the market, because as you can see right here, Credit Suisse's misfortune contrasts with most banks, which enjoyed an extraordinarily robust 2021. So it seems like they've been betting against the market since that toppiness in about 2015, 2016, when we still did have a little bit of quantitative easing that was slowed down, and they continued to ramp that up. Clearly, they did not catch the big W in early 2020 when the market did massively pull back, and have kind of continued that pattern. All right, so they are one of the few, as you do see, like it says right here, it contrasts with most other banks. The fact of them losing just it does not go with the trend. But seeing somebody like Credit Suisse, which didn't solely focus on being a hedge fund, decide to shut their doors is just another indication that the market that we're in is becoming to be not only, I don't want to say overinflated, but the fact of this easy money policy and borrowing money for nothing and just going wild on margin is, continuing to be a very, very risky situation. Okay, so their net income fell by 86% over 9 months, ending in September 30th to $475 million. Its investment banking division posted a nearly $2 billion pre-tax loss. All right, and they're blaming a lot of it, obviously, on the Archegos. But Credit Suisse also said that the fourth quarter of 2021 would be unprofitable because it expects to take a $1.6 billion write-down. Now, they're already trying to prepare their investors and prepare regulatory situations of losses going to continue. So they're already stating that they're going to be operating in the negative. You're going to see some poor numbers over the next 4 to 6 months. Now, what's going to happen, okay, depending on if the market continues to pull back, if interest rates continue to rise, if they do have a lot set out on margin or have a lot of just borrowed money, period, as those interest rates begin to rise, what could this potentially set up for Credit Suisse? This might just be the beginning, all right? So as we are seeing that they are closing the doors, all right, it does have, all right, March as the date for this. Like I said, because Credit Suisse is such a massive firm, this could just be the beginning. And, it'll be interesting to see as 2022 just started. So, guys, that's it for this video. I'm going to make another video talking all about what happened inside the Fed meeting today and why the market pulled. So stay tuned for that. I'll see you in the next one.